This is Taking Stock on Bloomberg. I'm Pimm Fox. What lies ahead for the credit markets? Siderow is the president of BlueMountain Capital Management. He says the odds are over the next couple of years that we're not going to see a rally. We're also not going to see any dramatic sell-offs. Siderow is also former associate principal at McKinsey & Company and also a former corporate attorney with Cleary Gottlieb. And it's welcome to Bloomberg. Good to have you with us, Stephen.
Thanks.
So what is this whole idea? Well, first of all, explain what is BlueMountain. It's a $4 billion credit hedge fund. What is that?
That's correct. We're a credit hedge fund, multi-strategy in the credit markets. We have about $4 billion in assets under management. Majority of our investors are municipal and corporate pension funds. And we've been around since 2003, and we have about 115 people in our two offices in New York.
Now, when you say credit hedge fund, that means you're going out and you're buying the bonds, you're buying the credits of various companies and perhaps even mortgage-backed credits.
That's correct. So when we think about the credit markets, what we mean and our approach is relative value investing in credit. The credit markets for us are, as you said, corporate bonds, corporate loans, mortgage-backed securities, and other asset-backed securities like credit card securitizations, auto loan securitizations, etc. What we don't really focus on, and we're excluding from this, is government and municipal securities. Interestingly, those markets that I described, excluding those credit markets I described, are larger than the equity markets. So the U.S. credit markets are about 18 trillion total. The broader equity markets around 12 trillion. So in fact, it's a larger market than the equity markets. And in the hedge fund space, again, you might be surprised to learn, there are relatively few hedge funds focused exclusively on the credit space. About half of all hedge funds focused on long-short equity, those equity markets I described, and probably less than 10% focused on the credit markets, and we're one of them.
So solely focused on the credit markets. When you talk about the future of credit, you're making the point that we're not going to see wild euphoria, nor are we going to see huge panics. Why are we going to be somewhere in between?
Well, I think some of your earlier guests were talking about the lack of leverage, the lack of lending out there is in some sense putting a cap on a future rally. And at the same time, the fact that a lot of these credit assets are now in less leveraged or deleveraged hands means we're actually also, our view is that the likelihood of a broad sell-off from here is also the less likely scenario. And we're actually seeing that and hearing that from a lot of our, as I said, pension fund clients and conversations we have with corporate and municipal pension funds. They saw the sell-off in 08. They enjoyed the rally in credit in 09. And now they're coming to us and saying, where do we go from here? How do we continue to generate returns for our pensioners, for our pension funds, but in a way that doesn't rely on a directional bet on credit spreads or where the credit markets are going.
What does relative value as a strategy mean? How does that work?
Well, relative value, not unlike what you see or hear about in terms of hedge funds in the long-short equity space, it means looking for relative mispricings as opposed to absolute or directional mispricings. So what we do typically is we'll look for an asset that's cheap and we'll get long, and then we'll look for another asset that we think is too expensive and we'll sell it short. And we'll look for these kinds of opportunities, creating a portfolio that doesn't have exposure to either a sell-off or a rally. As I was saying, that's kind of our approach, to have this more market neutral or relative value approach or absolute return approach.
Now, we saw in 2009 huge issuance by corporations coming to the market, issuing debt because, well, it was very inexpensive when you take a look at interest rates. Has that made the pool that much bigger for you to choose from?
Well, what has happened is you did see a spate of issuance sort of when spreads were tightened up and they could actually issue.
That's the gap between treasuries and corporates.
The gap between treasuries and corporates tightened up, and there was more issuance. But that took a little bit of a step back in May, and spreads are a little bit wider. Importantly, again, it does create a variety of opportunities. And I think what's interesting is, and distinct from the equity markets, are the fact that there are different kinds of corporate debt. There can be loans which are secured by specific assets, bonds which are unsecured and a general obligation. There can be asset-backed securities at the senior-most part of a corporate capital structure. Easy example would be some of the auto rental companies. Those auto rental companies like Avis and Hertz, typically at the top of the capital structure, the most secure part, actually securitize their auto fleets. And they sell bonds backed by the auto fleets. And then below that, there might be some loans.
So it's a real physical asset that's backing the bond.
Sure. So there's a physical asset at the top. Then there might be a loan backed by some other specific assets, not the cars. And then there might be some additional bonds below that are just backed by the general obligation. And as a credit investor, investor, and as specifically a relative value credit investor, you can choose where you want to be in that capital structure. You can choose to be long the ABS or short the bonds or vice versa, depending on where you see relative value. And importantly, because the market is very segmented, that is, there are some investors that can only invest in one and can't invest in the other, you see these mispricings.
All right, I want to thank you very much, Stephen Siderow, coming to us from Blue Mountain Capital Management, sharing some ideas and some insight into what's happening in the credit markets. Very interesting.
Pleasure.
Relative value credit hedge fund. Thank you.